Hello, great stock investors. Welcome back to our channel, where we dive deep into the world of finance, investing, and everything that impacts your money. Today, we're tackling a topic that's been on everyone's mind lately: the unraveling of the stock market, and the role former President Trump may have played in creating the perfect storm. From the boom times during his presidency to the economic crash we're facing now, we'll break down how Trump's policies, stimulus spending, and deregulation set the stage for one of the biggest market collapses in recent history. Whether you're a seasoned investor or just someone curious about the forces at play, you're going to want to stick around. Let's dig into how the stock market went from record highs to what many are calling a planned crash: Trump's market boom and its hidden weaknesses. During Donald Trump's presidency, the stock market surged to record highs, with the Dow Jones surpassing 30,000 points. Investors celebrated as profits soared, but beneath the surface, vulnerabilities were building: tax cuts, short-term gains, long-term pain. The 2017 Tax Cuts and Jobs Act slashed the corporate tax rate, giving companies more cash. Instead of reinvesting in innovation or wages, many opted for stock buybacks, which inflated share prices without improving productivity. While this boosted short-term investor returns, it left companies more leveraged and less prepared for future downturns. Deregulation, unleashing corporate America. At a cost, Trump's deregulation spree, including rolling back parts of the Dodd-Frank Act, gave businesses more freedom. While this fueled market growth, it also weakened safeguards, particularly in the financial sector. Risky lending practices began to creep back, leaving the economy exposed to shocks that would emerge later. Trade wars, the hidden market. Killer Trump's trade war with China, aimed at protecting American manufacturing, resulted in tariffs that disrupted global supply chains. Businesses faced higher costs, while industries like tech and agriculture suffered. Though the market initially shrugged off these concerns, the long-term damage from strained trade relations contributed to the market's underlying instability, inflating a bubble. Ignoring the long-term risks, much of Trump's market success relied on inflating a financial bubble. Stock buybacks, deregulation, and fiscal policies created a superficial boom, but these measures ignored deeper economic issues like stagnant wages, growing inequality, and rising corporate debt. The reliance on short-term market manipulation over fundamental growth set the stage for future volatility. COVID-19 exposes weaknesses. When the COVID-19 pandemic hit in early 2020, it exposed the fragility of the market built on Trump-era policies. The rapid market crash highlighted how vulnerable the economy was to external shocks, as companies quickly found themselves over-leveraged and unprepared to weather the storm. The recovery that followed, fueled by government stimulus, did little to address the structural issues that had been mounting for years. The COVID-19 crisis and Trump's economic gamble. As the COVID-19 pandemic swept across the globe in early 2020, it brought the U.S. economy to a near halt. Businesses shuttered, unemployment soared, and markets plunged. Faced with a looming economic catastrophe, the Trump administration, alongside the Federal Reserve, implemented an aggressive response. But while their actions may have averted immediate disaster, they also laid the groundwork for significant long-term consequences. Stimulus and market inflation. In an effort to stave off economic collapse, the Trump administration unleashed trillions of dollars in stimulus spending. This came in the form of direct payments to individuals, the Paycheck Protection Program, PPP, for small businesses, and corporate bailouts aimed at stabilizing key industries like airlines and energy. While this rapid infusion of cash kept the economy afloat, it also fueled a different problem: long-term inflation. The sheer amount of money injected into the economy created a short-term boost to consumer spending, and in turn propped up stock prices. However, this influx of capital also contributed to an unsustainable surge in asset prices. Real estate, stocks, and even commodities began to inflate far beyond their intrinsic values, creating what analysts termed an everything bubble. At the same time, the Federal Reserve played its part by slashing interest rates to near zero and implementing aggressive quantitative easing measures. This made borrowing historically cheap, encouraging businesses and individuals to take on more debt. Investors, flush with cheap capital, poured money into the stock market, further inflating asset values. For a while, it seemed like the market could only go up. But beneath this growth, the warning signs were clear. These inflated valuations were unsustainable. The everything bubble not only distorted the stock market, but also created false confidence in the stability of the economy. Investors were willing to overlook weak economic fundamentals as long as the Federal Reserve kept the money spigot open. This short-term gamble delayed the pain, but it ensured that when the bubble eventually burst, the fallout would be even more severe. The employment mirage throughout Trump's presidency. He often pointed to record-low unemployment numbers as a key measure of his economic success. By early 2020, the official unemployment rate had dipped to just 3.5%, the lowest level in over 50 years. On the surface, this looked like a strong indicator that the economy was thriving. But as with many of Trump's economic achievements, the reality was far more complicated. A significant portion of the jobs created during Trump's presidency were low-wage or part-time positions in sectors like retail, hospitality, and the gig economy. These jobs, while adding to employment figures, did little to provide workers with long-term financial security. Many workers in these positions lacked benefits like health insurance or paid leave, and their wages often weren't enough to cover basic living expenses. In essence, the low unemployment rate masked a deeper issue. Millions of workers were in precarious jobs that left them vulnerable to economic shocks. When the COVID-19 pandemic hit, these low-wage and gig economy jobs were the first to disappear. Restaurants, hotels, and retail stores closed en masse, leaving millions unemployed almost overnight. Gig economy workers, many of whom relied on platforms like Uber, Lyft, and DoorDash, saw their incomes evaporate as demand for services plummeted. The result was a sudden spike in unemployment, with over 20 million jobs lost by the end of April 2020. This exposed the fragility of the labor market that had been propped up by weak job creation. While the unemployment rate had been low, many of the jobs added under Trump's administration were temporary or unstable, leaving workers without a safety net when the pandemic hit. And even as the economy began to recover, many of these jobs didn't come back, leaving millions of workers in limbo. The pandemic's long-term impact on employment days. The pandemic stretched on, the labor market continued to suffer. Businesses, particularly small ones, struggled to reopen or operate under new restrictions. Many companies shifted toward automation, reducing the need for workers in certain roles. The jobs that were lost during the pandemic highlighted a troubling trend. While some sectors bounced back, others, especially those relying on in-person interaction, faced permanent restructuring. This permanent shift also exposed the limits of the Trump administration's economic strategy. The focus on short-term employment gains, without addressing underlying wage stagnation and job quality, left workers ill-prepared for economic upheaval. As businesses adjusted to a post-pandemic reality, millions of Americans found themselves in an economy that no longer had a place for them, underscoring the long-term weaknesses in Trump's employment legacy. In the end, the Trump administration's response to the COVID-19 crisis was a gamble that paid off in the short term by preventing a full-scale collapse, but one that ultimately fueled inflation, exacerbated inequality, and exposed the fragility of the American labor market. Post-presidency instability and Trump's lasting economic impact. As Trump left office in January 2021, the stock market was still riding the momentum of massive government stimulus and record-low interest rates. However, the underlying structural weaknesses in the economy, many of which had been amplified by Trump's policies, began to surface. What followed was a period of intense volatility, rising inflation, and a sharp reversal of the easy money era. Trump's influence on the economy didn't end with his presidency. His ongoing political battles and economic legacy continued to shape market conditions long after he left the White House. Political uncertainty and market volatility. Even after leaving office, Trump remained a dominant political force. His repeated claims that the 2020 election was stolen created a deep divide in the country and contributed to ongoing political instability. While it might seem like politics and the stock market operate separately, history has shown that markets react strongly to uncertainty. Investors thrive on stability, and Trump's legal battles, the January 6th Capitol riot, and his continued influence over the Republican Party created a level of unpredictability that made markets jittery. The question of whether Trump would run again in 2024 added another layer of uncertainty. Investors began to price in the potential for drastic shifts in economic policy, trade relations, and taxation depending on whether Trump, or a Trump-backed candidate, returned to power. While Wall Street had initially benefited from Trump's corporate-friendly policies, the erratic nature of his leadership left many investors uneasy about what a second Trump presidency could mean for the markets. Rising inflation and interest rate hikes. By 2022, inflation had reached its highest levels in 4 decades. Prices for goods, services, and housing surged, straining both consumers and businesses. While the COVID-19 pandemic played a significant role in global supply chain disruptions, much of the inflationary pressure could be traced back to the stimulus-driven economic expansion under Trump. The massive spending packages and artificially low interest rates during his presidency had created an overheated economy that was now due for a painful correction. To combat inflation, the Federal Reserve responded with aggressive interest rate hikes, ending the era of cheap money that had fueled market growth under Trump. Higher interest rates made borrowing more expensive, which directly impacted businesses and consumers. Companies that had taken on excessive debt during the low-interest years suddenly found themselves struggling to refinance loans. Startups and tech firms which thrived on cheap capital saw their valuations plummet as investors pulled back. The housing market, which had been one of the biggest beneficiaries of Trump's economic policies, also felt the impact. Mortgage rates soared, making homeownership less affordable and cooling down the real estate boom. Home prices, which had skyrocketed during the stimulus-driven market frenzy, began to stabilize or even decline in some areas. The end of the easy money era. One of the defining characteristics of Trump's economic strategy was his reliance on aggressive stimulus and low interest rates to keep markets soaring. However, as inflation forced the Fed to reverse course, the consequences of that strategy became clear. Many businesses had expanded under the assumption that cheap credit would last indefinitely, and as borrowing costs rose, some were forced to cut back, lay off workers, or shut down entirely. For everyday Americans, the shift was just as dramatic. The higher cost of living, combined with rising interest rates, squeezed household budgets. Wages failed to keep pace with inflation, leading to a decline in real purchasing power. The strong economic growth that Trump often pointed to was now being revealed as largely artificial, built on unsustainable policies that left the economy vulnerable to shocks. Lingering economic uncertainty. Even as new leadership attempted to stabilize the economy, Trump's economic impact remained deeply ingrained. The tax cuts, deregulation, and trade policies he championed continued to shape market dynamics. And with Trump hinting at a potential return to power, investors and businesses remained on edge, uncertain about whether another round of unpredictable economic policies was on the horizon. While Trump's presidency had delivered short-term market gains, the long-term effects were more complicated. The economic instability following his departure proved that an economy built on debt, speculation, and political turbulence could not sustain itself indefinitely. The market was now facing a reckoning, one that had been years in the making. The crash unfolds. By 2023 and 2024, the consequences of the economic policies that defined Donald Trump's presidency fully came to bear. What had initially seemed like a period of unprecedented market growth and corporate success revealed itself as a bubble waiting to burst. The combination of excessive corporate debt, spiraling inflation, rising interest rates, and lingering political instability created the perfect storm. The stock market, once buoyed by stimulus, buybacks, and deregulation, was now headed for a catastrophic crash. Stock buybacks come back to haunt corporations. During Trump's presidency, stock buybacks had become a common strategy for corporations to boost their stock prices, and by extension, shareholder wealth. Companies used the tax cuts and their excess cash reserves to repurchase shares, driving prices higher and creating the illusion of financial health. But by 2023, the very thing that once fueled the market's rise became its downfall. As the economy contracted and inflation surged, corporations that had spent their profits on stock buybacks found themselves dangerously cash-strapped. Rather than reinvesting in their businesses, many had exhausted their reserves to artificially inflate stock prices. Now, with the economy in decline, these companies had little room to maneuver. The cash that could have helped them weather a downturn was gone, and the consequences were devastating. Faced with rising costs and diminishing revenues, many businesses were forced to make difficult decisions. Layoffs became widespread, with some corporations shedding tens of thousands of jobs in an attempt to stave off insolvency. Once proud titans of industry found themselves struggling to keep the lights on, further deepening the economic crisis. The very stock buybacks that had enriched shareholders during Trump's time in office now came back to haunt the corporate world. The market gains had been fleeting, and the lack of cash reserves left businesses more vulnerable than ever to the worsening economic conditions. Banking failures and credit crunches. Inflation reached alarming levels, and the Federal Reserve responded with aggressive interest rate hikes. The pressure on the banking sector mounted. Banks, especially smaller regional banks that had benefited from Trump's deregulation policies, found themselves struggling in this new high-interest rate environment. Trump's rollback of certain provisions of the Dodd-Frank Act had made it easier for regional banks to operate with less oversight. While this initially seemed like a boon to these institutions, it left them ill-prepared to handle the rising interest rates that followed the inflation surge. As rates climbed, borrowing slowed dramatically, and banks faced significant losses on loans they had issued during the low-interest rate era. Some smaller banks, unable to withstand the economic strain, began to collapse. Banking failures sent shockwaves through the financial system, exacerbating an already fragile market. The collapse of these regional banks sparked fear among depositors and investors alike, triggering a broader credit crunch. As banks tightened lending standards to protect themselves from further losses, businesses found it increasingly difficult to secure financing. The resulting credit crunch had ripple effects across the economy. Companies, especially those reliant on debt financing, suddenly found themselves without access to the capital they needed to continue operations. This only further fueled the wave of bankruptcies and layoffs sweeping the country. With credit drying up, even once healthy businesses were caught in the crossfire. Housing market collapsed. The housing market, which had boomed during Trump's presidency thanks to historically low interest rates and soaring demand, was another casualty of the economic crash. As the Federal Reserve raised rates in an attempt to combat inflation, mortgage rates followed suit. What had once been a hot market for homebuyers suddenly cooled as mortgage payments became unaffordable for many. Housing affordability plummeted, causing demand to dry up almost overnight. The real estate frenzy of the previous years, fueled by cheap money and inflated home values, came to an abrupt halt. Home prices, which had been soaring, began to decline sharply. Those who had bought homes during the height of the market boom found themselves underwater, owing more on their mortgages than their homes were worth. The housing market collapse created a cascade of economic problems. Homeowners who were underwater on their mortgages faced tough decisions: continue paying for a home that had lost significant value or default on their loans. Many opted for the latter, leading to a surge in foreclosures. This in turn put even more downward pressure on home prices as banks tried to offload repossessed properties in a market with few willing buyers. The real estate sector, which had been a key driver of the economic recovery in the wake of the 2008 financial crisis, now found itself at the center of a new economic collapse. Builders halted new construction projects, real estate firms slashed jobs, and homeownership, a cornerstone of the American dream, once again seemed out of reach for many. Was this crash planned? While Trump didn't explicitly plan for a market crash, many of his policies created conditions that made one inevitable. The combination of deregulation, tax cuts that favored short-term gains, and a stimulus-fueled market bubble led to an unsustainable economic environment. As the stock market now grapples with the consequences, investors and policymakers alike are left to clean up the mess. The lesson here is clear. Short-term economic gains often come at a long-term cost. And while Trump may no longer be in office, the economic realities of his presidency will be felt for years to come. So there you have it, folks. Trump's economic legacy and how the policies he championed might have accelerated the market's downfall. The stock market is a complex machine, influenced by countless factors. But today, we've peeled back the layers on how short-term gains can sometimes come with long-term consequences. If you found this breakdown helpful, make sure to give us a thumbs up and subscribe to stay updated on all things finance and investing. Let us know in the comments what you think. Is this crash an inevitable result of Trump's policies, or are there other forces at play? We'd love to hear your thoughts. As always, thanks for watching, and we'll see you in the next video. Stay smart, stay informed, and keep investing wisely.